as do in any other market. So it really doesn't help because a lot of people aren't effective trading currencies, so they switch to these other asset classes, and they think it's going to make life easier for them. So it really doesn't, but I will share with you guys the information that you need in order for you to not trade the NASDAQ if you're not ready, right? Because what's going to happen is that you're going to just quickly blow your account, and I do not want that for any one of you guys, for anyone for that matter. So rather take it slow, build yourself up, become consistent and profitable, and then you can start looking at diversifying into other asset classes once your account size has enough equity to actually hold those positions. Okay. All right. Let's look at something much less distracting. Okay. I think this one is okay. Let's just use the USDJPY as an example. So I'll be getting a few slides together so you guys can have the slides for tonight's session, and then sort of like redo or just replay everything while you watch a video, because this is recorded. I'll put up the recording on the channel as well. Okay, so firstly, a breakout is something that you can describe as a previous either swing high, swing low, or support or resistance structure that has been broken. Okay, so a confirmed breakout needs to have the market close above or below a really solid support or resistance structure. Okay, now there's different ways to trade breakouts, but in essence, even if you're trading trend lines, right, because a lot of people will use trend lines like so, boom, right, and they'll trade the breakout of the trend line, and the retest of that is usually the entry, or the close of this particular candle below that trend line signifies a signal or an entry for them, right? And that's fine. Okay, I'm not against that way of trading, obviously. However, what you must be aware of or cognizant of is that any form of a breakout that you want to trade, you want to have confirmation in order for you to have consistent or a higher win ratio than you normally would. Because just a normal breakout, okay, if you've ever been in a situation where you've taken a normal breakout like this, for example, boom, the market closes below the trend line that you've drawn in, and now you're expecting the market to drop, right? So a lot of the time, you might see the market pull back initially, right? It's going to pull back initially and then head in your intended direction. However, your stop will be violated, it will be taken out, okay? Or you might be scared out of the position, because you're seeing immediately as you enter this market or you enter this trade, immediately your position goes into negative, which does play with a lot of people's emotion. Okay, it's quite normal, it's quite natural. You learn to develop sort of like the right sort of mindset in order for your emotions not to interfere with your trading. But obviously, when you're starting out, or even if you've been at it for a while, if you haven't worked on the emotional side of things, then you're going to panic and want to get out of the position. Okay, so the one way to avoid you getting tied up in a position or in a trade that has a high probability of stopping you out and still going in your intended direction, you want to wait for confirmation. Okay, all right, so you want to see the market pull back, right, retest that break of the structure, and then head in your intended direction. Okay, so let's drop down to one of the smaller time frames so you can so we can check this in a bit more detail. Okay. All right, so now if you're not aware of this is what we call a rejection candle. Okay, now guys, if you have any questions, just sort of raise your hand and I'll unmute you, and then you can ask a question, because we have a lot of different background noises and some people playing the TV and all of that. So if I was just to let everyone speak at the same time or unmute everyone, then we'd have an issue with the actual recording itself. So if you're going to be asking questions, right, just make sure that the noise level is down and just raise your hand and I'll unmute your mic and then you can speak, and then we can just take it from there. So we are looking at confirmation to give us sort of like that added edge, to give us that higher probability of that trade working out, because at the end of the day, trading is all about probability. So if you want to have the probabilities in your favor, you need to stack them using sort of like confluences, things that build a case in order for you to take a position confidently. Right? And for one, you need to first test whatever methodology or strategy you're going to be using. I did send through the strategies, about 3 strategies in the PDF and the ebook to the guys who requested it. And obviously, the new guys, you can just settle for the basic material, module 1 through to 4 for now, right? Familiarize yourself with that. But some of the more advanced guys, you can just head on through to that. And if I haven't sent it through to you yet, just send me a WhatsApp text now. It's just been a very hectic day. So this is what we call a rejection candle, right? Rejection candle is the market heading to a previous support or resistance structure, right? In this case, this is a support level, right? In the form of a trend line. Okay. Now, the rejection candle is usually a pin bar, right? A pin bar is this type of candle. Pin bar, it's called a pin bar. It just has a longer shadow than the actual body, right? So it represents rejection at that price because there's a lot of selling. There was previously a lot of buying up, heading up to this area over there. But as the market hit that level, boom, a lot of sell execution sales were executed at that particular level, which influenced the sell-off from that point. So what you want to do is you want to be very aware of all that, okay? Because in a sense, trading is very, very, very basic and simple. Right? It just needs you to focus on all these small nuances and really just train your mind and your emotions to sort of like understand the probability side of things. We're going to do an entire week regarding that. And once you have that sorted out, I'm pretty sure you'll never be nervous about any trade ever again. Okay, so with this rejection candle, this pin bar type candle, right, we want the wick or the shadow to be longer, okay, than the one at the bottom. So if you have, for example, let's just use this one, equal size wicks, right, long on each side, more or less the same amount of pips, then that usually indicates to us that it's not really a doji. I mean, it's not really a pin bar, but more so sort of like a doji, right? Which means that the pressure is still on from both ends. So you want something that's going to really give you that confirmation that the market is starting to move. Because what you also don't want to do, as the market trends only about 30% of the time, right? And it consolidates close to 70% of the time, you don't want to be caught in markets that are going to move sideways with you, right? So you don't want a market you enter now, then on Friday you're still $10 up, one pip up because you went with the standard contract and you only up $10 after 4 or 5 days. You want to get into movements or get into markets that actually have momentum and are moving. So one way is to wait for that confirmation candle and execute at the close of this particular candle. So if you don't get it on the first attempt, right? So if this happens, right? So if you get a doji, as soon as the market comes in, retests that previous support structure and comes and closes, and you see that you have sort of like a rejection candle that's not quite a rejection candle, you wait for the next candle for that to be confirmed. So if you get a candle that shows that the market is going down, this is supposed to be green and red. for most of you guys, I think you're more familiar with that. So if you get sort of like this green and red, then the candle that we are talking about right now, if you have that set up as green and red, is going to be that one. It's going to be red, which shows us that there is some momentum going down. And that's when we execute the trade going down short, and then obviously have our stop losses as well as take profits in place. Okay, now that is the safest way for you to enter into a breakout, because like I said to you, here's one thing that I don't usually talk about a lot. Okay. If you should get into the habit of just going back into markets and measuring the amount of pips, let's say a market pulls back, because you're going to find a lot of things that you didn't previously see before or read about or get from me. So this one is something that I learned quite a while back. And if you're looking at this candle, the swing low, this, let's just take the close of the candle. Okay, close of this candle on the H1. Now, a lot of times when we have a close below or above a support or resistance structure, we're going to have a pullback, right? It's quite normal, because what happens is, as the market moves, okay, let me just grab my pointer here. Okay, as the market moves down, there are traders who are going to be executing on the way down, right? There are those who are going to wait for the quote-unquote safe entry, which is going to be right here at this low. So we already know generally where most traders are going to put their stops, right? So when I say traders, I don't mean just retail traders, okay? Because a lot of people get this this idea, or there's this notion going around that the big banks or the major corporations, commercial interests, all they do is focus on getting retail money, right? I mean, as retail traders, we're not really up there with the institutional traders. Okay, institutional traders are the guys trading for the smaller banks, the guys trading hedge fund money. Okay, the guys are trading pension funds. Those are what the major corporations or the commercial interests will be focused on, right? So their way of trading is very simple, very basic, and generally what they do is they'll trade breakouts of the previous day's low. If it gets broken, they'll execute a trade to the downside, and they'll have these really good risk-reward ratios. I say this because obviously I have a guy that I'm currently working with. We've been working for like 2 years or so. He's a professional trader under a fund incentive, and obviously when we talk, I was really interested in what those guys were trading, because I really thought like it's this sophisticated sort of method that these guys use. I mean, all these, but it really turns out to be more or less some very basic stuff. The only thing is that they work a lot on the risk reward ratio side of things, because that's really what you can control in trading. You can't really control the outcome, but you can control the risk you put for each and every single trade, and you can control whether you get into the position or not, right? The rest is not in your control, it's in the market's control. So this is one way that they actually trade. Right? So they'll trade a simple breakout methodology like this. The market breaks below and they'll go short, right? And the market might pull back, because obviously we have big money looking to assume those positions. Because what happens is, if you sell here, okay, if you sell here at this white line and your stop loss is here, that simply means that if the market goes up, you are buying back what you sold at a higher price, which obviously means you're losing money. Okay. And therefore, there needs to be someone who is going to be selling to you at this point. And guess who's going to be selling to you at that point? Okay. The big boys, right? So the big boys will drive market up. Okay. So as the market is driven up, boom, what happens? they'll assume your short position. And in turn, let's say you mark the market that you traded drops 100 pips, it goes in your direction. You were right, but you're out of the market and someone else is making the money that you were supposed to be making. So whether you took a micro contract or you took a 10 lots, doesn't really matter, but someone is out there taking the money that was supposed to be yours only because your stop loss was, let's say, too tight. Okay, so now a lot of people, I'll go through the why we choose to have these very tight stop losses or no stop losses at all. Okay, but generally it's a fear of just losing because no one likes to lose, and we like to avoid losing as much as we can. So I mean, just one of the things that we need to sort of like get rid of when we embark on this trading journey. But the most important thing is that you just work on one thing at a time continuously. So if we're talking this now, that's generally what's going to happen, right? And the amount of pips will usually be roughly the same. So you can go back in your charts and then just try it out. Just isolate some support and resistance levels and look at where the market retraced back. Okay, so let's take this close here. It's going to be about between 20 to 30 pips, 25 to 30 pips to be exact, the pullback that usually occurs, right? So at this close, because that's where a lot of traders will be putting their stop losses, 25 pips from their entry, right? Or 30 pips from their entry. So the swing to the upside will usually be between 25 to 30 pips. Okay. So if you don't believe that, you can check it out for yourself. So with that in mind, we obviously know that we're not supposed to put our stop losses 25 to 30 pips from our entry, okay, unless you wanted to get tagged. So if you want to get stopped out and your trade just put off the table, then you should put stop losses that are 25 to 30 pips, because generally that's where the swings will occur. Okay, now I don't want to get into too much detail about how that occurs because that's not important, but the only thing that you want to focus on right now is how then do we avoid these mistakes and then do things correctly. So as I said, breakout, the most basic and fundamental way to look at breakout is to look at that support and resistance, and this cannot be viewed as a break. Okay, let me just clear this, guys. Just give me a sec. You do not want to view this as a confirmed break. You may take your chances with it if you're going to have an incredibly large stop loss. However, there's two ways to approach trading. Okay, it's either you are searching for a very high win ratio, which means you have to win a lot of trades in order for you to make money, or you are looking to have a average win ratio, but your wins are much bigger, right? So you always have to make that sacrifice, whether you want to have small, consistent winners, let's say a 98, 96% win ratio, but usually that's going to be small winners and you're going to have larger losses, or you flip it the other way around and you're going to have large winners and small losses, and you're going to have, let's say, 50% win ratio or 60% win ratio. Okay, now there's ways to tweak it and improve it, but generally, I mean, if you want to make $600 for every $100 or $700 for every $100 you lose, then you're good even winning half your trades. Okay, so that shouldn't be an issue at all. So as I was saying then, with this is what we call a confirmed. Okay, now I'm not saying that this is okay. Let me check it though first. Let me see. Okay, I mean obviously it's in an upward trend, so definitely wouldn't be looking to go short on this one. But if I was, this would certainly look like something that I would go short in trading the breakout methodology. Okay. Now, if you guys have received the PDF already or the ebook, you know that there are 3 ways that I generally approach a market. So three strategies that I use. One is used generally for sideways consolidating markets, so meaning I can scalp, right, and make some profits short term. And then I use the more swing trade oriented market, or strategy rather, methodology, when the market is trending nicely, right? So when the market is in trending mode, bearish or bullish, up or down basically, then I know that I have much more pips, many more pips to actually play with, because sideways consolidating markets don't really pull in a lot of pips, but trending markets pull in a lot of pips. So that's when you can really play around with your risk reward and have much higher profit factor, okay, and Sharpe ratio. So as I said, this is as basic as you'll get with the methodology, with a breakout. Now, a breakout can also be used on moving averages, okay, as we'll see in this particular example. So this is the 200 EMA, okay, so the 200 moving average. We have the market bounce off this 200 moving average. So like I've said before, moving averages are generally used as support as well as resistance. Okay, so a break of a 200 moving average is usually viewed as a continuation of a trend. So if the trend is down, or a change of the trend, so if the trend is down and the market pulls up a little bit and then breaks below that 200 moving average, it's usually viewed as a continuation. So if we look at this very closely, okay, let me get my writing tool there. Okay. Boom. Right, we have this bounce off. Okay, the market closed below, and then the market pulled back up again, and then completely closed below this moving average. Okay, so now this is a breakout technically, because the candle itself closed below that 200 moving average. Technically, that is a breakout, right? But that's not the type of breakout that you want to be trading if you want to have consistent results and a higher win ratio, okay? So, because this method can work as well. Like I said, this is very easy to follow. You just market closes below the 200 moving average, and you just short the market. Okay, but you have to have a really good risk reward ratio in order for you to do so. Okay. I think we have a question. Yeah, I can talk now.
Since there's a breakup, like there's a highly possibility that the market will sell, right?
Yeah. So if the market is trending to the downside, for example, right, then the market breaks below a particular price area and retests, right? Because what we're talking about really is just the retest side of things. And retest, it actually confirms that there's a high probability that the market will move down. Okay.
Okay.
Right. So it's essentially what we'd like to see if we were looking for an actual trade setup, of which right now we're not, because I mean, like I said, this market, I tend to trade in line with the trend. Okay. So in terms of breakouts, if you're looking at breakouts for the past couple of weeks, okay, these are the breakouts that have been confirmed. Just give me a sec. Struggling with my. Okay, so these, right, so this has been a breakout. Okay, this was a previous support structure. Okay, this was a previous rather resistance structure, right? The market rejected and came back, right? Popped above and then came back again, and that was the entry point, right? Now you can see we did say that the type of candle that we want to see around the rejection point is one that signifies that the market is heading upwards. The shadow on the downside should be a bit longish than the shadow on the upside. Okay, so this one you could have entered somewhere around here, right? Or you could have waited for the second green candle to push higher in order for you to get into this one. Okay, so that would have been an entry, a confirmation, because like I said, if you look closely for these types of breakouts, you're going to have these pushes to the upside, right? And immediately you're going to have a pullback, which is usually about 25 to 50 pips from the close, right? So this is the close. That's where most traders will be entering. So the pullback will be about 25 to 30 pips. This one is 39.43 pips before the market heads in your direction. So if you had a stop loss and you entered without waiting for that confirmation of the market to pull back, then you had a problem. So you got stopped out and the market headed in your direction. Okay.
Okay.
All right. So you're good.
Yeah, I'm okay.
Okay. Perfect. Okay. So yeah, these are just past examples, guys. You'll be able to sort of like go through the market and do your own type of research, because most of the time, or the most time that you should be spending is just doing some basic research, okay? Finding out what the market usually does, finding out your markets. That's really just going to completely blow your mind and just give you a really different understanding of what the markets are. I'll be handing out Excel spreadsheets on how you can document the important pieces of information you find in whatever market that you're going to be trading. But like I said, some markets are not as effective to trade a certain strategy. So I can tell you the markets that are effective to trade whatever strategy and the most profitable one, but you won't really have enough confidence when it's not working the way that you thought it would until you do your own testing, whether it's back testing or you just use the trading simulator software. But we'll set that up, I think, in the third week. If you have that and you've done the research, I mean, 2 or 3 or 4 trades, losing trades won't freak you out like it normally does to most traders. Okay. Right, guys. I think we have about 10 minutes left. Okay. Are there any questions? Right. Before we close off the session, does anyone have a question regarding tonight's session? Right. So if you guys, okay. Yes.
If like since the when you put the trend line, it has break the trend line in the market, right?
Yeah.
So I can see that the formation is a M formation, right?
Well, you can call it that.
Below the,
Yeah. Yeah, I'm familiar with that.
It was a it's a M formation, right?
Yeah.
If it was a W formation,
Okay.
would you and it didn't break the trend line, but it was a W formation, what can you conclude about the possibility of the market?
Okay, if it was on the trend line itself, so you're saying it formed on the trend line itself here?
Yeah.
Let me see. So this, you said there's a W formation exactly here, and it didn't break the trend line.
Yes.
Okay, obviously for me, I mean, I'd definitely be looking at a buy opportunity around there. So if I had placed the trend line, a really solid trend line, and the market just came and banged on the trend line and formed a W type pattern, right? And I mean, you'd also have to have a few other things, right? Because that's not the only thing that I look at. If you've taken a look at the ebook, I like to see the big figures, right? I might use a moving average every now and then. I might use the Heikin Ashi candle, depending on how the market is trending. But if I see the pattern, right, I'll use a few things to confirm, and if definitely it's in line with my confluence, then I'll certainly be taking that. Right? But as it is just alone, then I highly doubt it. right?
Okay. Okay. Okay.
But if it's supported, if it rejects, it doesn't break the trend line. Generally, you want to go in that direction because this is an uptrend. But I don't like trading against the trend. Right? I mean, I would rather buy here, right here, where the market is. You see this line that I've drawn on here, 108.25. I'd much rather buy there than try to short around that area because it's anyone's guess. A lot of people try to pick where the top is going to be, right? And when the market starts trending, it starts trending. So you don't want to be against the market trend because it can trend for a week, it can trend for 52 weeks. So you never generally know exactly how long it's going to trend. So what you want to do is align yourself with the trend, and if that bounce or that trend line forming that W is in line with the trend, then certainly go for it because you're going to have more bang for the buck. You're going to be able to get more pips out of the move than if you are trying to short going against the trend. Okay.
Okay.
All right. Okay, guys, do you have any other questions? Okay, so if you guys don't have any other questions, I'll end off tonight's session right here. Oh, and what I'm going to do, I'll send out a notice in the WhatsApp group about when we're going to start doing analysis. But generally, it's on Monday around 7 p.m. We do analysis. We look at the markets entire week. What my thoughts are, right? They're just my thoughts, guys, on what the market is, right? Obviously, I love your guys' input. You tell me what you think, and you ask whichever markets you want us to take a look at, and that generally gives us an idea of how our trading is going to be for the rest of the week. Okay. So if you feel like you don't need the basic stuff, just drop me a WhatsApp message, okay, and I'll send you the ebook from now. Okay. All right, guys. Hope you guys enjoy the rest of the evening. I'll check you guys in the next session. Cheers.